In this section, we will shift our focus to managing risk from an investment and trading perspective. By the end of this session, you will be able to distinguish between risk management techniques for a trading portfolio as opposed to an investment portfolio. You will also understand how to achieve the benefits of diversification in a trading portfolio and be able to identify potential criteria for optimizing risk management at the strategy and portfolio levels. To begin, we'll talk about risk management in an investment portfolio. Investment and trading portfolios have the same overall objective, maximizing risk-adjusted return. Investment managers accomplish this by identifying undervalued assets based on fundamentals or other criteria and combining them into a portfolio. Systematic risk affects the value of all assets, but to different degrees, which we will discuss later. For now, think of systematic risk as coming from macro factors such as GDP growth, employment, interest rates, or credit spreads. Systematic risk is often measured by the volatility of the overall market. In an absolute sense, the market should include all investable assets such as stocks, bonds, real estate, commodities, and cryptos. As a practical matter, it is usually represented by beta or by the VIX, which is the volatility of the S&P 500 index. Idiosyncratic or unsystematic risk affects a single asset such as the stock of a particular company. The impact of quarterly earnings announcements, especially surprises, is a good example. We will measure risk by the volatility of an asset's price. You can reduce idiosyncratic risk by diversifying your portfolio. You can achieve diversification on many levels, including across asset classes, geographic regions, and industry sectors. Two main ways to diversify a portfolio are to hold imperfectly correlated assets and to increase the number of assets held. The risk of a portfolio is measured by the ratio of the covariance of a portfolio's return to the variance of the market return. This is portfolio beta. A portfolio of U.S. stocks that is fully diversified would have a beta of 1. When a portfolio is diversified, the risk of the portfolio, or its variance, is reduced to the level of systematic risk, the risk of the market itself. You can see that a high level of diversification can be achieved with as few as 10 assets. The total risk of any portfolio is composed of systematic risk and unsystematic risk. Increasing the number of securities in a portfolio reduces the unsystematic risk component, leaving the systematic risk component unchanged. You can see how the addition of geographically diversified stocks allows you to achieve a higher reduction in risk than a portfolio composed solely of domestic stocks. Next, you will see that the level of additional diversification that is possible by including international stocks depends on which geographical region the stocks come from. The table shows the correlation between different asset categories. You can see that the correlation between U.S. large cap equities and equities from EAFE, or Europe, Africa, and the Far East, and emerging markets, EME, are still fairly high. This could be due to the fact that global markets were in a long uptrend during the period these correlations were measured between 2009 and 2019. To get maximum diversification, you really need to add other asset classes to your portfolio, such as currencies or fixed income, which have a negative correlation with U.S. large cap stocks. One thing to keep in mind when you are diversifying geographically is that you will be exposed to FX risk when you convert your foreign returns into your own currency. As we saw in the previous correlation matrix, exposure to FX risk can also be a good way to diversify. Most of the funds managed by portfolio managers are constrained to invest in a single asset category. This means investors must diversify their portfolios by investing in several funds focused on different asset classes.